All right, let's get right into it. Today, we're going to break down a really powerful framework for building an investment strategy that's not just reliable, but repeatable. It's time to build your own investor's blueprint.
You know that feeling, right? You're just drowning in choices. Stocks, real estate, crypto, NFTs. Everyone's shouting at you about the next big thing. It can be totally paralyzing. Where do you even begin?
And let's be real, this quote, it's a bit of a gut punch, but it's true for a lot of us. It's kind of wild when you think about it. We spend more time planning a holiday shopping list than we do our own financial future. Well, that's what we're going to change today. Look, the answer isn't another hot tip or some secret stock. The answer is a system, a structure. It's a universal blueprint that you can apply to literally anything, stocks, property, you name it. And we're going to build it using what I call the four-pillar framework. So here's our game plan. We'll start by tackling that feeling of being overloaded. Then we'll build our blueprint, pillar by pillar. We'll look at an asset's real strength, how to read the market story, figure out exactly how you get paid, and, this is so important, how to protect your capital. By the end, you'll see exactly how it all locks together.
Okay, pillar one, this is the foundation. It's all about looking past the hype, past the noise, and really understanding the core strength of what it is you're buying.
We call this fundamental analysis, and the best way to think about it is like this. You'd never buy a house without checking the foundation for cracks, right? Well, this is the exact same thing for an investment. For a company, it means you're digging into the financial reports, the income, the assets, the debt. It's a health checkup, plain and simple. And this is where it gets real. Let's just compare two companies side by side using actual numbers. Take the PE ratio. Company A is way lower, which could mean it's a bargain compared to its earnings. Plus, its earnings are growing more than twice as fast. And look at that price to book. It's almost 1-to-1, meaning the stock price isn't totally detached from the company's actual assets. Company B? It just looks expensive. See, we're not guessing here. We're running a financial checkup. And this same logic, this same principle, it applies to everything. You just use different tools. Let's talk about industrial real estate. Those huge windowless warehouses that power all our online shopping. You're not looking at a PE ratio. Instead, you're looking at something called funds from operations, FFO, which is basically the real estate version of cash flow. Or you're looking at the weighted average lease expiry, the WAL, to see how long your tenants are locked in. A long WAL means your dividend check is way more secure, even if the economy gets rocky. It's the exact same principle. You're just checking the vital signs. Okay, pillar 2. Here, we're shifting our focus. We've looked at the asset's internal health. Now, we're going to look at the external mood of the market. This is all about the psychology of every other investor out there. This quote is just so powerful. I mean, think about a scandal like Enron. The company's fundamental numbers, they were a complete lie, just made up. But the chart couldn't lie. The chart was telling the real story, showing a company in an absolute freefall long before the rest of us knew why. And that's really the key difference here. If fundamental analysis is about the financial condition of an investment, then technical analysis is all about the emotional condition of the market. A chart is just a picture of fear, of greed, of indecision. It is the story of the market's collective mind. And you can actually read that story through patterns. So, for example, a doji candle, what you see here, it shows this tug of war between the buyers and the sellers, and it ends in a draw. It's a big flashing sign of pure indecision. A death cross, on the other hand, well, that's when a short-term price average dips below a long-term one. It's a really clear signal that the market's momentum has turned negative. These things aren't magic, they're just visual clues about market psychology.
All right, now for maybe the most important question of all. How does this investment actually put money in your pocket? I mean, this is the whole point, isn't it?
Most people only think about number one. You buy low, you sell high. Simple. But a really complete investor knows how to make money no matter which way the market is going. You can actually profit if the price goes down, that's called shorting, and you can even make money if the price goes absolutely nowhere, just sideways, by collecting income from things like rent, dividends, or even selling options. Knowing all three just opens up a whole new world of possibilities. Your strategy really comes down to your goal. You have to ask yourself, why am I buying this thing in the first place? Are you buying a hot tech stock hoping for a quick pop, a capital gain? Or are you buying a logistics REIT because you want that steady, predictable cash flow from dividends? Or maybe you're just buying it to protect your portfolio against inflation as a hedge. Your goal changes everything.
So far, we've been focused on the fun part, making money. But the pros, the people who actually last in this game, they are just as obsessed with not losing money.
And this right here shows the critical difference. Amateurs speculate. They chase fads, they act on feelings, they ask their buddy, hey, tell me what to buy. And they have zero plan for what happens if they're wrong. Professionals calculate. They use a system like this one. They know their exact exit point before they ever even click buy. They know their risk. And this gets to the absolute core of a professional mindset. It's not about trying to avoid losses. That's impossible. It's about making sure that any single loss is small enough that it doesn't take you out of the game. You decide what you're willing to lose before you invest, and you make peace with it.
The good news is, you're not going in there defenseless. You have a whole toolbox for managing risk. Let's go back to that real estate trust. What's the big risk there? It's often interest rates. If a REIT is loaded with debt and rates go up, their profits can get absolutely crushed when it's time to refinance. So your risk management is checking their balance sheet for that debt before you ever buy. It's about position sizing, making sure no single investment, no matter how amazing it looks, can ever wipe you out.
So how do these four pillars actually work together? Because they don't exist in a vacuum. They combine to form this powerful, top-down strategy that gives you a truly complete picture of any investment. You actually use the four pillars as the very last step in a filtering process. You start big. What's the whole market doing? Is the tide rising or falling? Then you narrow it down. Maybe you see money flowing into the industrial sector because of a reshoring trend. Then, within that sector, you see that logistics hubs near major ports are leading the pack. It's only then, once you've found that strong corner of the market, that you zoom in on one specific company and apply the four pillars to build your investment case. So look, this framework isn't just theory. It's a practical, actionable blueprint for making calculated, confident decisions. It's what shifts you from being a passive spectator, just watching the market go by, to being the active architect of your own financial future. So the only real question left is, what are you going to build?